you're seeing an environment where, the acquisition by the biggest money in the world continues unabated. And I think what would happen would be that the price would go high enough that it would keep the public out at some point. I think they'll continue to let it go higher and higher and higher. I think it will back a new system. I really, truly do. I think it's being quietly reintegrated into the monetary system. And you can see it around the globe through all the deliveries. You can see it here in the United States as we become a net importer, and the massive month over month over month over month massive deliveries into COMEX. So yeah, I think this is happening. I think gold is quietly being reintegrated into the system. And I think it'll go higher than anyone thinks possible. I really do.
Central banks worldwide are increasingly rethinking their reserve allocation strategies, signaling a significant evolution in the structure of global monetary policy. According to a recent survey conducted by the World Gold Council, WGC, 76% of central banks anticipate increasing their gold holdings over the next 5 years, while nearly as many expect a decline in their US dollar reserves. This shift is occurring even as gold prices remain elevated, with the metal recently reaching a record high. Over the past 3 years, central banks have collectively added more than 1,000 metric tons of gold annually, well above the average for the previous decade. The WGC attributes this growing appetite for gold to its proven resilience in times of crisis, its role as an inflation hedge, and its value as a portfolio diversifier. Andy Schectman highlights the scale and intent behind these actions, particularly the wave of gold repatriation from traditional vaults such as the Bank of England and the New York Federal Reserve. More than 40 central banks have moved their gold back into domestic custody, underscoring a rising distrust in intermediated claims and paper contracts. According to Schectman, the trend of physical deliveries from exchanges like COMEX and the LBMA signals a decisive move away from futures-based exposure. He warns that in the event of a financial shock or systemic crisis, a sudden surge in retail demand could lead to a severe supply shortage. The infrastructure for physical gold delivery is not designed to accommodate rapid or large-scale shifts in investor behavior, especially if institutional and retail interests converge simultaneously. As Schectman notes, gold's reintegration into the global monetary system appears to be occurring incrementally, yet with unmistakable momentum. While most individual investors remain unaware, institutional actors are quietly positioning themselves ahead of what many see as an inevitable revaluation of monetary assets. Gold and silver currently represent less than 0.5% of global financial holdings, but even a modest reallocation, rising to just 5 to 10%, would likely overwhelm the existing supply chain. With production controlled by a limited number of sovereign mints and refiners, any major geopolitical disruption could prompt governments to prioritize national demand, limiting exports and reducing international access. Now, we present the clips from Andy's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I do see it happening. It's taken over number 2 spot in global reserves, surpassing the Treasury. Passing the euro just recently. It's now number 2 globally in reserves. It's interesting. Goldman Sachs came out with a report that I've been talking about for 2 years through various sources, but now they come out and say, the central banks are buying way more than they're telling us. China's buying at least 10 times more than they're telling us. I've been saying that for 20 years because the numbers that China always talked about never went up, ever, for year over year over year. They stayed the same, but they're the largest producer in the world. And so you're seeing an environment where, the acquisition by the biggest money in the world continues unabated. And I think what would happen would be that the price would go high enough that it would keep the public out at some point. I think they'll continue to let it go higher and higher and higher. I think it will back a new system. I really, truly do. I think it's being quietly reintegrated into the monetary system. And you can see it around the globe through all the deliveries. You can see it here in the United States as we become a net importer, and the massive month over month over month over month massive deliveries into COMEX. So yeah, I think this is happening. I think gold is quietly being reintegrated into the system. And I think it'll go higher than anyone thinks possible. I really do. as
What do you?
markets typically do. And Rick Rule, who I know you've had on your show, and he's done more for me than anyone in the world, and I just did an interview with him the other day, and he said it to me again, Andy, the allocation of gold and gold-related equities, not just gold, but gold-related equities too, across the entire financial matrix from Joe and Jane Sixpack to the Harvard Endowment Fund is less than 0.5%. We added 14,000 clients in 45 days when Silicon and Signature Banks failed in 2023. That's 4 years worth of client acquisition. And of course, they bailed out the banks illegally, and that went away, even though they're not supposed to do that. Ask the folks in Lindsay, Oklahoma about that. They experienced a first bank bail-in October of last year. But anyways, I digress. The point of it is that at that super high level that we see right now, at the really, really high level, the central banks, the commercial banks, what are they all doing? Not only are they all buying, but the common denominator that I think isn't talked about enough is the repatriation and the deliveries. 40 plus central banks have repatriated their gold from the Bank of England and the New York Fed. Why? Those are the two depots that gave access to the COMEX and the LBMA. Instant liquidity, safe jurisdiction, stable. No, we don't care anymore. We'd rather be a little more inconvenienced and have it in our own possession. All of a sudden, you're seeing the largest deliveries ever off the history of the COMEX. No, that's okay. We're not going to take paper futures anymore. We're not going to leave it in the ecosystem. We'd like to have it. Thank you very much. Where do the coins come from that the people that at our level buy them? Where do we get them from? Well, they get them from the mints. Where do the mints get the gold from? Most of it from the COMEX and the LBMA. What's happening to the COMEX and the LBMA? It's being bled dry. And we, the people who are listening to this show who will buy the gold and silver, represent the pimple on the elephant's rear end. The elephant has no idea about any of this yet. The people like you and I do. But what I'm getting at is that you can see at the high level, they're already pre-positioning themselves. And by the time it becomes something that is observable, rather than doing the research and being early and doing things when they're not in favor or not considered conventional, those are the people who are sitting prepared. But everyone else who acts just in time after it becomes visible by their eyes, you bet 100% there will be no gold and silver available. They'll buy ETFs or they'll buy whatever they can. But the physical market, which is flush with product right now, just like that, can change. If you realize that there's 6 major mints on the globe, that's about it. A handful of refineries and mints, but you got the US, Canada, Austria, Australia, South Africa, and the United Kingdom. At some point, if things got that crazy, don't you think these mints would stop sending their gold across the globe to the United States so that we can buy it and maybe they'll take care of their own people? I'm saying yes. I have said forever in my belief, and it always comes across like, yeah, right, he's talking his book, but I'm not. This market will be defined by an inability to source product before the music stops, because it will be. There's such a small percentage of people in it right now. When that number, if it just got to 10% of people's assets, that would be right now a 20-fold increase in demand. It would be over in 48 hours.
Well,
so
that would be scary
5%,
for those.
yeah.
That would be scary for those who are left out, who didn't buy the fire insurance before the fire.
That's exactly right. And, it's something that it's very hard to convey with it coming across genuine. I try so hard to be honest about this that I've seen throughout my whole career periods of time where the mints shut down and the product is just gone. And I'll say one other thing. One thing that people don't take into account, the reason that they say there's no bull market like a gold bull market, Gary, is because every other bull market, like in anything, stocks or crypto or whatever, you make a bunch of money and you're told to pull some of that money off and go buy yourself a new Ferrari or reinvest or do whatever you want to do. But with gold, when the price is going higher and higher and higher in this environment in particular, it only reinforces the mentality you employed to buy it to begin with. And fear is a far greater motivator than anything. And I'm not going back into dollars. I don't care. I don't need a new car. I'm going to protect myself and my family. This is why I did this. In other words, the secondary market completely disappears. No one is selling. So when the mints are gone, that's it. And that's something to keep in mind as well. This will be something that happens very quickly, where all of a sudden it's very flush, and then boom, there's an awakening, and very quickly the industry, which is a just-in-time industry, just like everyone else, when they run out of product, getting it from across the globe may be next to impossible. So yeah, it will happen.
Andy Schectman has raised serious concerns about the direction of U.S. monetary policy ahead of an expected leadership change at the Federal Reserve. A new Fed chair is likely to align with the Trump administration's economic goals, particularly the push to grow the economy out of a 7% deficit to GDP situation. One strategy reportedly being considered is raising the inflation target from 2 to 3%, which Schectman views as a tacit acknowledgement that real inflation is already significantly above what is officially reported. He points out that government measures, such as the Consumer Price Index, fail to accurately reflect reality for most Americans, as they exclude essential items like food, housing, and energy. In his view, this policy shift would do little more than confirm the erosion of the dollar's purchasing power that people are already experiencing. Schectman also points to the potential significance of candidates like Judy Shelton, who supports sound money principles and has publicly discussed the idea of issuing 50-year Treasury bonds backed by gold. He notes that this type of thinking reflects growing global discontent with fiat-based systems. Since 2014, there has been virtually no new central bank demand for U.S. treasuries, while gold accumulation has accelerated. Gold has consistently outperformed government bonds and carries no counterparty risk. Schectman believes that the world is moving away from the current Western financial model, and that the choice of Fed leadership will determine whether the U.S. responds with real reform or doubles down on policies that have already stretched the system to its limits.
I don't know that that in and of itself makes that big of a difference. I mean, you could argue right now that inflation is far, far higher than we are being led to believe. It's kind of like the CPI is a funhouse mirror, right? It distorts what you're really looking at. It excludes food and energy and housing. You ask John Williams of Shadow Stats, he'll say add an 8 in front of the number. And that's what it really is. You're talking about 11%, not 3%. Your rent has gone up 20%. Your grocery bill is nearly doubled. Your insurance bill is down here in Florida is through the roof. The CPI from the Bureau of Labor Statistics, you could remove the L and call it the CPI from the BS, is something that I take exception with to begin with. So maybe it just actually has them be slightly more truthful. To me, the issue with the new Fed chair is, what are their policies? And one of the people that I've interviewed myself was Judy Shelton, who was his nominee in 2016 to run the Fed. And many people think she's on that short list of those that would be head of the Federal Reserve. She is someone who advocates for issuing a Treasury bond, 50-year in maturity to begin with, denominated backed by and deliverable in gold. She's told me, by the way, in no uncertain terms, that Trump has told her that on July 4th of next year, 2026, which would be the 250th year anniversary of the country, that he would issue these Treasury bonds pegged to gold. Someone like Judy, who is a Austrian economist at heart, who understands sound money, who understands the principles of gold, understands that our Treasury market has been weaponized and has lost appeal globally. This Western-based rules system that has really benefited the West is something that much of the world is pushing back against. And that's why since 2014, Gary, net, there's been no new central bank buying of treasuries. Now, there's been plenty of central bank buying, but not any new central bank buying. And now we have countries like China who are selling treasuries in favor of gold, which has outperformed the treasury for 25 years. Gold has outperformed by 2 to 1 the 10-year treasury since 2000. It was up 40% last year against 4% on the treasury. It's up 35% this year. It continues to beat the performance of the treasury, but it has no counterparty liability, no counterparty risk. And one could argue very much the same liquidity at those levels. And so this is a trend that we see happening. And to Judy's point, why would anyone want to take our treasuries in a world where austerity is thrown out the window, where the current administration, even with Doge, really can't do much to bring down the debt? In fact, they're raising the deficit this year another $2 trillion and wanting to get rid of the debt ceiling altogether. So the point of it is that I think it matters from a standpoint of who's in the chair. Is it someone that would understand the principles of sound money, or will it be more of the same of debt monetization and manipulated interest rates and all of the frolicking, if you will, or the shenanigans on a monetary basis, or let's just call it brain dead monetary policy that has got us into this pickle to begin with. So let's just cross our fingers and hope it's someone with a true understanding of sound money, of Austrian economics and libertarian viewpoints as it pertains to a more free market system, if that's even possible at that level, that would come in and help right the ship. Well, it's funny. I could argue that they're kind of doing that in a very stealth manner already. They're supposed to be doing quantitative tightening, right? But 10 days ago, 2 weeks ago, they came in and very quietly bought $45 or $8 billion worth of 3, 10, and 30-year treasuries, a sampling of all three. Why did they do that if there is so much demand for it? You've had the Treasury come in and do two $10 billion week after week buybacks of longer dated maturity treasuries by issuing short-term debt to pay off the long-term debt, which can be very dangerous in the scope of things. And both things speak to the lack of demand for the Treasury, which is why even when they tried to lower rates, the 10-year yield went higher. That's the problem that we find ourselves in. If the Fed comes in and tries to lower rates when we clearly cannot normalize our balance sheet, when we clearly have chosen inflation over austerity, when we are clearly going around the world and imposing tariffs and sanctions and weaponization of the dollar and the Treasury, not to mention the irresponsibility of our fiscal and monetary policy, you lower rates. And at some point, the rest of the world just says, enough of this already. We're not going to buy their treasuries any longer. Look, you can still use dollars, but a bigger deal to the West would be not reinvesting proceeds into the U.S. Treasury market. That's a bigger deal than, I think, lack of dollar settlement, which it still represents north of 50, almost 60% of all settlements are done in dollars, if not more. The point of it is that you are killing the demand for treasuries. Yeah. And that's why you're seeing rates go higher, even when they're trying to talk about lowering rates and quietly coming in and doing QE. But to your point, yes, that would be the playbook. If all hell breaks loose, they're going to have to lower rates. But that just accelerates, not only it reaccelerates the engine of inflation, which really never went away, just being masked. Yeah. But it also, I think, accelerates the demise ultimately of this entire system, one that's based on trust. And we've lost a good deal of our trust, not just from a standpoint of the weaponization, but also from things like our monetary policy, which I think if you're a holder of U.S. Treasuries over the last few years, you understand that. The greatest volatility in the history of the 10-year Treasury was a year or two ago. The dollar's down 10% this year. So if you have a Treasury, 10-year Treasury yielding 4%, well, so far this year, the dollar's down 10% and gold's up almost 40. What's been the better play? Right. I think that's why you're seeing them move away from treasuries independent of the weaponization. This is just accelerate their incentive to do it.
Gold is increasingly positioned to become the cornerstone of a new global monetary reality as policymakers confront mounting debt burdens and the limits of fiat-based stability. With inflation targets quietly shifting and confidence in long-term fiscal discipline weakening, the appeal of anchoring value to a tangible, historically trusted asset is gaining traction. In such a scenario, gold is not merely a hedge. It becomes a necessity for preserving credibility in a system where traditional instruments are losing trust. This evolving backdrop suggests a future in which gold demand accelerates not just from central banks, but from institutions and individuals seeking protection against currency debasement. As supply constraints tighten and preference shifts toward physical settlement, the market could face severe dislocations. If this trajectory continues, gold may no longer be viewed as a defensive asset, but rather as a core component of a restructured and more secure global financial architecture. Share your thoughts on Andy's analysis of gold prices in the comments section below. If you find this video informative, please support us and turn on notifications to stay updated about our latest videos. See you in the next video. Thanks for watching.